Good afternoon, and thank you for joining us for today's webinar on federal tax, brought to you by McKonly Asbury. Today's speakers will be Mark Heath and Marta Horst with McKonly Asbury. If you have any technical difficulties or feedback during the webinar, please use the built-in chat function in the webinar software to send us a message. Also, please submit questions during the webinar as well, and we will answer your questions either during the webinar or at the end if we have time. We will be posting a recap of today's presentation on our blog at www.macpas.com/MA-news. Look for that post to be up by the end of the day tomorrow. You will be receiving CPE credit for attending this 1-hour webinar. CPE certifications will be sent out via email within the next week. Without further ado, here we go with Mark and Marta.
Good afternoon, everyone, and thank you for attending our webinar on the federal taxation of fixed assets. My name is Mark Heath. I'm a partner here with McKonly Asbury, and I've been with McKonly Asbury for about 8 years, having previously been at Arthur Andersen and KPMG.
Hi, everyone. My name is Marta Horst, and I have been with McKonly Asbury for about 5 years. I am a senior manager with the tax department, and prior to coming to M&A, I was with KPMG for 5 years. During today's webinar, we are going to be discussing 3 main topics. The first topic will be tax depreciation and just the general rules and how tax depreciation should be calculated for fixed assets. The second topic we're going to be discussing is cost segregation of fixed assets. And the last and probably most of our time will be discussing the new tangible property regulations. These were released by the IRS at the end of February and are effective the beginning of this year. So there are a bunch of changes from the 2008 proposed regulations, and we'll be discussing a lot of the changes that were made by the regulations. When calculating maker's depreciation for tax purposes, there are 3 main steps that the taxpayer needs to take in determining what percentage of maker's depreciation should be included. The first step is determining the property class. This would be whether it's personal property or real property, and also one aspect to determine here is the business use percentage. Most likely the business asset is used 100% for business, but in some cases autos might have a personal percentage use, in which case that would affect the total depreciation allowed for the year. The second step would be to determine the appropriate maker's percentage, and the third step is to calculate the actual depreciation based on the maker's depreciation. When determining the applicable maker's depreciation percentage for a fixed asset, there are 3 components that we need to use in order to find the correct percentage. The first component would be your recovery period of the asset, whether it's 3, 5, 7, or 10 years, or even above that for real estate would be 27.5 or 39 years. The second component is your depreciation method. Most taxpayers will use 200% double declining balance, but in some cases 150% declining balance or even straight line is used. And the last piece of in determining the applicable percentage is your convention, whether it's half year or mid-quarter. Half year is for most assets, but we will be discussing mid-quarter convention in a slide or 2.
One thing to note here on the choice of class life, in the past few years at least with bonus depreciation, it hasn't really been terribly important. As long as the useful life of the asset was less than 20 years, it didn't really matter whether you were 3-year, 5-year, 7-year, whatever, because we got bonus depreciation, and particularly in the years where we had 100% bonus depreciation, you were getting the entire cost of the asset written off anyway, so it didn't really matter. But as we'll discuss later on, this is going to come back into play because as of right now anyway, bonus depreciation is going to be going away.
One of the areas that we find clients forget to analyze when putting assets into service is which convention to use. Most systems default to the half-year convention, which 90% of the time is correct. But at the end of the year, clients need to analyze how much assets they put in service during their 4th quarter. If 40% or more of their personal property assets were placed in service during the 4th quarter of their year, then mid-quarter convention applies. And mid-quarter still allows depreciation, it's just at a lower percentage compared to the half-year convention. Real property, on the other hand, doesn't have a choice. You always need to use the mid-month convention when putting real property into service.
And as Marta stated, the mid-quarter determination only applies to personal property. So if you were to place, excuse me, if you were to place a large building in service at the end of the year, that's not going to factor into your calculation. So don't think that that's going to automatically throw you into mid-quarter.
One of the things we do suggest is that most fixed asset software does allow or does provide a mid-quarter report, and it's a simple report that the software can say, hey, this is how much fixed assets that were put into service per quarter, and it's a quick analysis to determine whether mid-quarter would apply for your personal property assets.
And you may even want to look at that before the end of the year, before you start placing assets in service, to say, oh, if we place this many assets in service in December, it's going to throw us into mid-quarter. We don't really want to do that, so maybe hold off on purchasing some new assets until the next year. It's all part of the analysis that you want to look at to figure out where you're going to fall in terms of depreciation this year versus next year.
As Mark and I both stated, bonus depreciation is coming to an end as of now at the end of 2012. Now there is talk about extending some of these tax benefits, but as of now, as in 2013, bonus depreciation is going to be zero. Bonus depreciation in some form has been available to taxpayers since 2001. And one of the advantages of bonus depreciation that it is available to all businesses. There was no investment cap for bonus depreciation, so any new property placed in service was able to be depreciated much faster than under regular maker's depreciation. On top of that, 179 deduction was originally developed for small businesses, but over the past couple years, especially during 2011, the cap to that businesses were eligible for 179 deduction had risen greatly. But as of 2013, the cap is down to 200,000 of assets placed in service is eligible for an accelerated deduction of only 25,000 compared to 139,000 in 2012. So as a result, we want clients to definitely look at their capital expenditures for 2012 and really analyze if they're going to be if they're sure an asset is going to be placed in service, whether it's the end of 2012 or beginning of 2013, the asset should really try to be placed in service in 2012 to try to capture some of these accelerated deductions that are available this year.
And as Marta alluded to, one of the questions we get a lot is, do we think bonus depreciation is going to be extended? Obviously, we don't know. Although with the current political climate and the election coming up, it depends who wins. It depends who wants to posture before the election, which side of the aisle. I would be surprised if there was no kind of extension of bonus depreciation, especially because with the 179 deduction, the limitation falling so greatly, it's going to be a huge hit to businesses losing the tax deductions for depreciation, and also for manufacturers who are making equipment that people are buying. If all of a sudden businesses don't have an incentive to go out and buy all this equipment, the kind of the ripple effect of this could be pretty big. So I would be surprised if there's no extension. But with that said, I've been surprised before, so we'll just have to wait and see. So far, we've kind of covered all the basics of depreciation, useful lives, that sort of thing. What we're going to get into now are more the planning items that you can do to make sure we maximize our depreciation, we accelerate our depreciation, make sure we get the biggest bang for our buck on our capital expenditures. One of the big things out there are cost segregation studies. Now, we're not going to get too in-depth on this. We just want to make sure you know what it is, how it's done, and what it does for you. We at McKonly Asbury, we don't do cost segregation studies generally. It's a very specified field, specialized field, and we partner with a firm that specializes in these things. So for our clients, we would bring these outside experts in to go through the study. And the reason for that is we want the best people out there to do it. It's expensive to be the best at this, and we've just found our clients get the best result with us partnering with another firm. So we'll start off with the basics here of cost segregation studies. What is it? It's basically the process of separating the costs of tangible personal property, other tangible property, indirect costs, and land improvements from building and improvement costs, separating the personal property from the real property. If you're currently building a new building or you have plans to build a building in the near future, this is definitely something you should consider. Again, with bonus depreciation going away, you want to make sure we're maximizing everything that we can. So the obvious question is, why do it? Why spend the money to do a cost segregation study? Really, it all comes down to time value of money and accelerating your depreciation. For real property, you're stuck between either a 39-year useful life depreciation period or a 27.5-year depreciation period, depending on whether it's commercial real estate or residential real estate. For every item in those buildings that you can identify as personal property and pull those out of those 39 or 27.5-year property and put into 15, 7, or 5-year property, your depreciation is obviously going to be accelerated greatly, and your time value of money of your investment into this building is you're going to get a return on that investment much more quickly.
And in addition to getting the lower depreciation life for some of these components of the building, with the new regs that we're going to be talking about shortly, some of the repairs that are considered that you have to do are required now to be bifurcated from the entire building itself. So not only are cost segregation studies nice to accelerate the depreciation, in the future with the new regs, we're going to be required to split the windows out in order to, when they're replaced, to capitalize them.
One of the next questions we get is, does this have to be a new building? And the answer to that is no. It does not have to be a new building. As long as the building was acquired after 1986, it's eligible for a cost segregation study. Now, one thing to consider, though, is you can do a study on an old building. However, if you've already owned the building for 5 or 10 years, you've already, A, taken a significant amount of depreciation on your real property, so you're going to lose that benefit in that you've already taken some of the deductions. So the cost of doing the study you're not going to get quite as big a bang for your buck there in that. Although there could be very large deductions for anything that would already be fully depreciated had you put it into 5-year property. So if right now it's sitting in 39-year and it's actually 5-year property, if you're 7 years into the building and you identify something as 5 years, you get that entire depreciation deduction in 1 year. So there's an upside, obviously, but there is a downside you need to consider as well. If you are building a new building, the process for a cost segregation study will really start with the engineers and the architects. It goes outside of the accountants. They're going to look at all of the plans for the building. They're going to look at blueprints. They're going to look at invoices. They're going to look at cost sheets. They're going to look at all this stuff to try to identify where the most personal property can be pulled out and separated from real property. Obviously, they're going to focus on the specific areas where they can get the most benefit. And only an architect and engineer, they're going to be the ones who are going to be able to look at all this stuff to specifically know how this stuff can be separated from real property. I'm not an engineer. I'm not an architect. So we're going to use them. They'll do that. They'll give us the answer. We'll calculate the tax benefit. So now you might be wondering, well, what specific types of buildings are going to be eligible for cost segregation studies? There is no hard and fast rule as to this type of building is eligible and this type of building is eligible, but we've seen them done on all kinds of buildings: warehouses, grocery stores, retail space, banks, restaurants, apartments, office buildings, hospitals, manufacturing facilities, sports and recreation facilities, and hotels. Of these, where we've seen the most benefit would be definitely manufacturing facilities, restaurants, hotels, and grocery stores. The reason for that is, especially manufacturing facilities, there's a lot of customization that goes into the building. You have all the structural components, you have the walls, you have the roof, you have everything else. That's obviously common in all buildings. But when you start talking about, well, we need this specific type of utility line, or we need this specific type of plumbing coming from wherever going to a machine. Anytime you have those kinds of specific things that aren't incorporated into the walls, that aren't incorporated into the ceilings, that's where you're going to get your most benefit, which is why we see it most in manufacturing facilities, restaurants, And also hospitals are a big one as well, because they have so much customization with all the different types of equipment that they have, the way they power them, the way they supply them with water, whatever goes into it. Anytime you have that high level of customization, that's where you're going to see a whole lot of benefit. One thing to consider also with cost segregation studies is the bonus depreciation available. Bonus depreciation is obviously available as long as we are able to identify assets that are less than 20 years. So over the past 10 years, since 2001, you're able to get huge benefits from these cost segregation studies. So not only are we talking about a benefit going from taking an asset over 39 years to 5, 7, or 10 years, we're talking about taking an asset that we were originally going to depreciate it over 39 years, and now we're depreciating it 100% or 50% or whatever percent immediately. So the benefit of this in the past has been great, and if bonus depreciation were to continue going forward, it's going to be there as well. Now we're going to talk a little bit about how do we determine whether something's personal property or real property. And actually, maybe I should back this up a little bit to talk about why this is such a specialized area. You might say, well, I'm building a building. I know what's personal property. I know what's real property. And you might, the easy stuff, you'll definitely be able to tell. Where we really see the benefit, though, is there's a lot of costs in these buildings that people just assume are real property. And unless we look at them specifically, unless we do these types of studies, they just get lumped in with 39-year property. And you might say, oh, well, what's a few bucks here and there? But once you start adding everything up, these are going to be big amounts. And also, you'd be surprised as to what the courts have agreed are considered personal property versus real property. The list of questions that you need to ask to determine whether something is personal or real property is, the first one is the property movable? Can you pick it up and take it somewhere else? For instance, if you move to a new building, would you be able to take this piece with you? Has it already been moved? Meaning, did you buy it from someone else and they had it in their building and now you're picking it up and moving it into your building? Is it permanent? Is it permanently attached to the building, the structure, the walls, whatever? Was it designed to be permanent? Would it be a major project to move the property? Would the property be damaged if you moved it? If you need to bring in a crane and I don't know what else, and it's going to be this huge major project, well, maybe that lends to the fact that it might be real property. If it's going to ruin the machine if you try to move it, then obviously that probably tells you that it might be real property. But if those things aren't there, if you can move it without too much trouble, then you have a good case there that it's personal property. Some of the examples of personal property that you may not otherwise think would be classified as personal property: flooring, carpeting, and carpet padding, electrical wiring, plumbing, movable partitions, security systems, exhaust equipment, for example, dust collection system in a manufacturing facility, decorative lighting, emergency generators, land improvements, signage, wall coverings, and window treatments. These are all things that the courts have found that are to be considered personal property. And you may not always think it's personal property, but it's always good to take a look. One thing, though, you do have to consider, I gave that specific example of a dust collection system. If we're calling these things personal property, depending on the state that we're in, they could be subject to personal property tax. So something, real property would be exempt from this, personal property is not. So we are going to get a benefit for accelerated depreciation. However, if there's a personal property tax associated with this asset, once we classify it as personal property, it's personal property. So you just need to make sure that you weigh all the considerations. The specific case where we get all information for cost segregation studies is Hospital Corporation of America versus the Commissioner. And here, in this case, I'm just going to give you some very specific examples of things that were found to be personal property in that case. The electrical distribution system, the wiring and related property items in labs and maintenance shops, wiring to televisions, conduit, floor boxes, and power boxes, electrical wiring related to internal communications, carpeting, vinyl wall and floor coverings, kitchen water piping and steam lines, special plumbing to x-ray machines, kitchen hoods and exhaust systems, patient corridor handrails, and accordion doors and partitions. So while I previously gave you some general examples, those were some very specific examples. Obviously it relates to hospitals only, but hopefully that just gives you a better idea of specific things that you can look for and how specific things would apply more to manufacturing facilities, hospitals, hotels, restaurants, things like that, just to give you some more to think about in terms of cost segregation studies.
Mark, I think this is when it can be confusing, because one of the questions that you asked earlier is the property permanent? Is it permanently attached to the building? And most of those items you probably would say yes, like in the carpeting, the wiring, plumbing, electrical. I would have said most of those things would be permanently attached to the building, but as case law says, that they are eligible to be personal property and therefore depreciated on an accelerated basis.
Yeah, that's a great point, and that's why these cost segregation studies are so important, because, just like you said, most people would just assume that all these things are permanent. But when you dig into it, though, and start asking all the questions, specifically is it movable? Would it be a major project to move it, or would it be damaged significantly if you did move it? All the specific things that I listed from the case law, there's definitely an argument there. Well, you could move it, and honestly, it doesn't matter if you actually do. It just matters if you could. So don't think that just because you're not going to move it, or you might say the question of, well, who would actually move that? That's not the question to ask. The question is, can it be moved? Okay, so now that we've talked a little bit of the background of cost segregation studies, we need to talk about what's the IRS going to look for. Should this come under audit? What's the IRS going to want to see to justify this cost segregation study? Extensive documentation. I know that's what you would expect from the IRS. It's no different here. They're going to want to see all of the blueprints. They're going to want to see the invoices. They're going to want to see the cost sheets that we talked about earlier. They're going to want to see all of these specific items to make sure that you have all of the underlying documentation. What the IRS does not like is reconstructed data. So if you go back afterwards, you've thrown out all the invoices, the blueprints are, in somebody's basement somewhere, and you go and say, oh, well, we just went around and looked at the building and said, well, this item was connected to this, and we probably paid this much for that. Unfortunately, that's not going to fly with the IRS. They don't like things reconstructed. You're going to need all the original underlying data. As I said, comprehensive records, all the invoices, cost sheets, and also a standard methodology, meaning, well, for this part of the building, we went this route on how we were going to identify all these items, and on this part of the building, we took a little bit of a different route. The IRS isn't going to like that. They're going to want to see that you said one methodology for the whole building. The reason is people were going to use different methodologies for different parts of buildings based on which is going to get them the biggest benefit. Obviously, the IRS wouldn't be a big fan of that, so you just need to make sure you have a standard methodology for the whole study. Finally, just a couple notes on when cost segregation studies may not be a viable option. If you're planning on selling the property in the near term, in the next couple years, probably don't want to do a cost segregation study, because any depreciation you take, any accelerated depreciation you take now, is just going to be recaptured back into income as gain if you sell it in a couple years. So you're not going to get the benefit of the time value of money there. If the owner of the building, if the entity owning the building doesn't have taxable income, obviously accelerating your depreciation, the cost outlay to do the study, it's not going to benefit for you, because all it's going to turn into is a net operating loss. And generally, we've seen the most success if the cost of the building is greater than $1 million. Less than $1 million, probably not going to find quite as many costs that we can pull into personal property, get accelerated depreciation on, and get the time value of money to justify the cost of the study. So that's it on cost segregation studies. And again, we're going to be talking more about planning items here. On any specific questions that you might have on any of this, submit them now, or you can discuss them at the end.
So now we're going to move on to the new tangible property regulations and discuss briefly how the changes that were originally proposed in 2008 the things that have changed in determining what needs to be capitalized compared to what was previously expensed. In general, the regulations were developed in order to help a taxpayer determine what is considered an improvement to property or a deductible repair. And the regulations provide the definition for what is considered a unit of property, and then you're required to apply a series of tests to that unit of property in order to figure out if the expenditure would need to be capitalized or is currently expensed. In comparison to the proposed regulations from 2008, the new regulations provide for a much smaller definition of unit of property. In general, the larger of a unit of property, the more likely an expense will be considered a deductible repair because they are proportionately small compared to the larger unit of property. So now that the unit of property is much smaller by definition, improvements will be considered capital expenditures and need to be capitalized rather than expensed as done previously. There are a significant number of changes from the proposed 2008 regulations to what was effective the beginning of this year, and that's what we're going to focus our discussion on. The main significant changes include the definition of improvement to property, your definition of routine maintenance and materials and supplies, as well as acquisitions and the dispositions of maker's property. One of the more significant aspects to the regulations are the improvement to property, which is also known and referred to as the repair regulations. In general, the amounts paid to improve a unit of property must be capitalized. And I keep referring to unit of property, and the definition of unit of property is an expenditure that is treated as a capital improvement if it improves the building structure or any individual building system. And building system is everything that is included within the building. So HVAC system, plumbing, electrical, alarms, protection or security systems, they would all be applied separately. Although they're one single unit of property, each of these building systems need to be analyzed separately when considering if an improvement to property has been made. In order to determine if an amount needs to be capitalized if there is an improvement to property, there's three different areas that the regulations define as an improvement to property. The first one is a betterment of the property, and betterment of the property is defined as a material increase in capacity, production, efficiency, strength, or quality of the unit of property. In general, the regulations state that the taxpayer needs to compare the condition of the property immediately before the expenditure, and if the expenditure would relate to normal wear and tear of the property, then the condition of the property needs to, after the fix of the wear and tear, needs to be compared to the last time the repair was done, the condition of the property the last time the repair was done. So it can be kind of complicated, but basically it's saying that if there's an increase or a betterment to the property in its working condition, that would be considered an improvement to property and therefore capitalized rather than expensed.
Yeah, and all these, we're talking a lot of textbook definitions here, and that's kind of the problem with going from proposed regs to temporary regs and trying to operate under them. Obviously, under the proposed regs, you're just getting kind of an idea of where the IRS is going, and they're going to get taxpayer feedback. They're going to get feedback from all different types of organizations. And then once they put the temporary regs in, we have the rules, we have the definitions, but unfortunately we don't have too much practical application of them yet. So it's very difficult to get specific examples and get specific things of what the IRS is going to consider betterment. You essentially just have to wait for somebody to challenge things and push the envelope to get case law out there. So right now, again, we have these textbook definitions. We're just going to have to see how it plays out to see how all of these, how the term betterment is specifically applied to different scenarios.
The second component to an improvement of property is called restoration of the property. And the three separate definitions of restoration of property is the rebuilding of a unit of property to like new condition after the end of its class life, is an expense of a major component or substantial structure to part of the unit of property, or the expense returns the unit of property to its original efficient operating condition after the replacement of a part or a combination of parts that comprise a major component. Now I know that gets really complicated. So some examples of a restoration would be if 200 of 300 windows would be replaced in a building rather than 30 of 300. Like, that is a major component of the unit of property. Or the entire roof is replaced on a building. Again, that it would be considered a restoration because that's a major component or substantial structural part of the unit of property. The last piece of the improvement of property is the adaptation to a different or new use. And this is basically saying that if a taxpayer buys a unit of property and puts it into service for X amount of years, and then in year Y decides that, you know what, we're going to rebuild this machinery and equipment or this unit of property and use it for this completely different use, that expense to rebuild the unit of property is considered an adaptation to a new or different use. The original use of the asset is not what the new intended use of the asset would be. So those expenses would need to be capitalized for the improvement of the property rather than expensed.
And these concepts aren't terribly different from kind of what we always dealt with. It's just questions of, are we improving the useful life of the asset? Are we making significant betterments? Are we changing the use of it? Are we extending the life of a building for another 20 years by doing these things? It's not just a repair or maintenance question anymore. It's looking at all these things, and also it's not just looking at the building as a whole. It's looking at all the specific components of the building. Like Marta talked about the windows, you have to look at all those things separately, and it's not an option anymore to just say, well, it's all just one building. You have to be looking at all these specific things now.
Our next slide discusses the routine maintenance safe harbor aspects of the regulations, and by general definition, as we all know, routine maintenance is keeping a unit of property in its ordinary, efficient operating condition. One thing that I found interesting is it's only considered routine maintenance in accordance to the regs if it's recurring in nature and it's considered a practice by industry or manufacturer's recommendations, and the taxpayer expects to have these expenses at the time the unit of property is placed in service. So if it's not considered routine and recurring, then it falls back to the improvement of property that we just talked about and would be considered a betterment or adaptation of the property, and therefore would need to be capitalized into the property itself. The last bullet point on here talks about safe harbor, and it says the regulations state that the routine maintenance safe harbor does not apply to buildings or its structural components. And some of the questions that I had when analyzing this would be, well, then what about a window? A window would be considered a structural component of the building, but therefore we can't apply the repairs and maintenance, the routine maintenance aspect, to a window of a building, that kind of thing.
Yeah, and as we discussed before, we don't have any concrete examples of these things yet, but you know, if you break a window, that wouldn't be covered under the safe harbor because it's a structural component, so then you have to go back to the other piece of it and look at the betterment, improvement, all that kind of stuff. So it seems kind of silly, but again, as we go through this and we get more examples, whether they're from RevProx, whatever, from the IRS, we'll be able to see exactly where they're going with all of this.
The next component of the new regulations refer to the definition of material and supplies. And on our slide here, we have a list of what is considered materials and supplies. In general, it's tangible property that is used or consumed in the business that would not be accounted under inventory. So if the property would fall under one of these four, not including the last one, which is just other guidance, it would be considered a material or supply. In general, the taxpayer can elect to capitalize materials and supplies, or they can also elect to expense the materials and supplies and apply the de minimis rule in order to expense them. Most manufacturing clients are already capitalizing materials and supplies under the UNICAP rules, so some of this is probably already being capitalized rather than all expensed.
Yeah, I don't see a huge change from this, but you know, essentially, whatever you're considering materials and supplies before and just expensing them when you bought them, probably you're just going to be able to continue to do that now. I do want to say, though, I love the last point. They say, or as identified in other future published guidance, basically leaving the door open to say whatever else they want to tell us can be considered materials and supplies.
The next component of the regulations are the acquisitions. And in general, amounts paid to acquire or produce tangible property must be capitalized. And these costs would include your invoice price for the asset, any transaction costs, bidding costs, appraisals that would need to occur in order to put the asset into service. All of those would go into the capitalization of the asset. The regulations do provide a de minimis rule saying that if you are able to have all of these three categories, then the taxpayer can elect to deduct the costs rather than capitalize the costs. I don't think any of these, except the one aspect which I'll talk about in greater detail, is new to the de minimis rule, in the fact of you must have an applicable financial statement. Applicable financial statement provided by the regs is defined as a financial statement provided to the SEC or a financial statement used by creditors or for any non-tax purpose. So the taxpayer must have a financial statement. The next component is the taxpayer must have a written financial accounting policy for expensing the amounts costing less than a certain dollar threshold. I think most taxpayers probably did have a policy of what their threshold would be, whether they capitalize or expense a cost. Another side note is that accounting policy is able to be applied to the entire consolidated group. So if you have multiple entities in a consolidated group, you are allowed to have one accounting policy, but the policy needs to be applied at each individual company within the consolidated group. The last and most significant part of the de minimis rule is that the total amounts paid cannot exceed a ceiling amount. And I found this very interesting because the ceiling amount definition is the total amounts paid and not capitalized must be less than the greater of 0.1% of the taxpayer's gross receipts or 2% of the taxpayer's total book depreciation and amortization. So the total amount that is expensed rather than capitalized cannot be greater than either of those two amounts. Now, again, going back to the written policy, the policy must be applied to each individual entity and not the consolidated group as a whole. So you need to look at each entity rather than the consolidated group's gross assets or their book depreciation, and then apply and say, okay, our total expense amount of the acquisitions that we're expensing currently cannot be less than this amount. Or not cannot be greater, sorry.
Yeah, and if you're thinking this just got a whole lot more complicated, you're right. It did. It's unfortunate that you can't just say anymore, well, anything under this dollar amount we're just going to expense. You can start out that way, but at the end of the year you have to go back and look and say, did we go over the ceiling? Once we see this in practice, depending on the company, then we'll be able to get a better idea. Unfortunately, I think what's happening here is the IRS is trying to go after companies that had a very aggressive expensing policy. Say they would say anything other than $5,000 is automatically expensed, and for their industry, for their business, whatever, $5,000 might be way too high. So unfortunately, the IRS it feels like they have to come out and do something to stop this abuse, and unfortunately, we all have to pay for it.
One thing to add there too is if it is determined that the amount expensed exceeds the ceiling amount, then no amount is allowed deductible. So if you've expensed so much and realized you're over the ceiling amount, then you have to go back and capitalize the entire thing. It's not like you can go back and just go to your ceiling amount.
So it might be a good idea to look at your policies now and say, okay, apply them to last year and say, okay, where would we have fallen? Would we have lost all these deductions for tax purposes? So look at your policies now. If you have to change the policy now before next year, obviously it's too late for this year, but before next year so that you can maximize everything for next year, you might want to do that now, because once you get to the end of the year and figure out that you have too many expenses, it's too late. You can't just go back and change your policy.
The last aspect of the new regulations that we're going to talk about is the disposition of maker's property. And I consider this a very significant change, and that is actually favorable for the taxpayer. The new regulations provide that the retirement of a structural component of a building is now considered a disposition of maker's property. Under prior law, if a taxpayer would have replaced half of its roof, you would have to capitalize the replacement part and also continue to depreciate the old roof over the life of the asset. Now, under this new law, it's more of a blended approach in the fact that the taxpayer can now dispose of the replaced portion and then capitalize the new portion of the roof. So in the prior law, we weren't able to get the deduction of the disposed asset, but now we can. So this would fall under the improvement rules in the fact that you have to capitalize the replaced part, but now can take the deduction for the disposed asset.
Yeah, and this is something now that is a positive because it obviously just makes more sense. Before, the example that Marta gave, if you replace half your roof, obviously you're replacing half of it, or you're putting the new roof over the old one because the old one wasn't functional anymore, so you should be able to write that off. You should be able to dispose of it and not get kind of whipsawed on both ends here with having capitalized the new cost but still depreciate the old cost over the remaining useful life.
The one downfall to this, although it is taxpayer favorable, is that, as we discussed before, a component would include, as stated in the slide, windows, doors, electrical wiring, and so forth. Now that the deduction is allowed for the recovered asset, the taxpayer does have the burden in determining the basis of the disposed asset. So if a building was put in service for $5 million and half of the roof is disposed of, the taxpayer has the burden to determine what is the cost basis of half of the roof in order to take the deduction for the disposed part of the asset. The last component that we're going to discuss is called the general asset account, and this is when a group of assets that have the same depreciation method, recovery period, convention, and they are all placed in service in the same year, then the taxpayer is allowed to take this group of assets and put only one asset in their fixed asset software. But similar to the old law, no loss is allowed to be recognized on the disposition of these assets. Therefore, any costs associated to improving these assets would be considered a repair. So we went through a lot of law and what the regulations state, and the question that you're probably asking now is what do we need to do now? What are taxpayers required to do now? And the main areas that you need to assess now are your capitalization policies. I know we talked on this briefly, but with the new de minimis rules and the routine maintenance expenditures, you need to make sure that you have a written policy in place, similar to what Mark talked about earlier, that you know that you will fall under the de minimis category when you put an asset placed in service and you expense it right away under the acquisition rules.
Yeah, and as Marta said, reviewing your policies is obviously important. Also, just the initial setup of everything, educating the people who are going to be entering the fixed assets into the software. What we find with many of our clients is the people doing it, they have an accounting background, they might be a CPA, but they don't necessarily have a tax background, so they're not really thinking about these things. And they should be educated to think about them. Make sure you get it right the first time so you don't have to go back through, make changes, and especially with places where you have these very large, voluminous fixed asset reports, it's very hard to go back through and try and pick out stuff that's right, wrong, where it should be changed. So it's obviously much easier if you get it right the first time.
Going back to what Mark talked about with the cost segregation rules, taxpayers might want to evaluate whether cost segregation study is required or would be helpful in their situation in order to also take advantage of the new disposition regs that we just talked about, in order to, if half of your windows are replaced, then to take the loss on those replaced windows rather than just capitalizing the new cost of the assets. A cost segregation study would help you determine what the cost basis is of those assets that are replaced.
Yeah, the overall message is just make sure you're aware of these things, you're thinking about them, so it's not February and you're trying to go back and figure out everything that you did the last year. make sure you're communicating with your tax preparer, with your tax advisor, so you can bounce all these things off and just plan ahead of time. So again, so you're not scrambling at the end. Thank you everyone for listening in on our webcast today. We now going to take a few minutes to answer any questions that you might have. It looks like we've already got some questions waiting in the queue, so we're going to start off with those now.
The first question that we have is in response to electrical wiring. Under the regulations, the question asks, it's considered a structural component of the building, but when we talked about cost segregation, it was not considered a component of the building. And the question is wondering what the difference is.
The difference focuses mainly on what is electrical wiring for. In some cases it's going to be real property, in some cases it's going to be personal property. Like we talked about with a manufacturing facility or a hospital, if you're running electrical wiring to something that is specifically identified as personal property, then that special electrical wiring that's going to that personal property is going to be considered electrical property. So it depends on what the function is. If it's electrical wiring just going to your standard lighting, that's going to be real property. If it's electrical property, or if it's electrical wiring that's being run to decorative lighting, since the decorative lighting is going to be considered personal property, the electrical wiring associated with that is also going to be considered personal property. The next question we have up here, someone's asking for the ceiling with the de minimis rule. Can I just make my policy that we're going to deduct everything up to 0.1% of gross receipts or 2% of our total depreciation and amortization for the year?
Unfortunately, the short answer is no. That's not allowed. The regs specifically address this in that the fact that the written financial accounting policy must be below a certain dollar threshold. So you can't have a range or a percentage calculation in the policy. It must be a certain dollar amount, and therefore putting in the definition of the ceiling amount wouldn't be acceptable.
Yeah, although I like the thinking. I like where
I
you're
agree.
going with that. Unfortunately, though, I don't think it wouldn't work. You need to have an actual dollar amount that things would be expensed under.
The next question that somebody asked is, what happens if we don't have a policy in place for 2012?
Unfortunately, the only answer is get one as soon as possible. If you don't have one in place right now, all you can do is get one, put it in place, figure out what's appropriate in terms of a dollar amount, and you can make it effective January 1. That's going to be your best bet. That way, hopefully everything from the beginning of the year forward would be covered. Just keep in mind, though, since you didn't have a policy in place in the beginning of the year, there is some potential exposure there. However, I don't know if I would foresee the IRS really coming down hard on that, especially in the first year. Another question we had waiting, going back to the cost segregation studies, someone asks, can I do my own cost segregation study? The answer is yes. There's no rule that says you have to have an outside independent third party or anything like that. However, you need to look at, do I have the expertise in-house? Do I have the engineers, the architects, the people who are going to be able to really break out and separate all those costs? Do I want to have those people spending the time to do that, knowing that they might spend a lot of time doing this? It might be, there might be a lot of headaches there. And am I going to get the biggest bang for my buck? Am I going to be able to identify all the potential assets that can be pulled out and split into personal property? If you have the expertise in house and they have availability, and you're confident that they can take care of everything and get you the greatest benefit, then absolutely go for it. You might be able to say, well, hey, they can just spend a little bit of time and we'll get a little bit of benefit. We may not get the biggest benefit possible, but we don't have the cash outlay, so we're okay with that. But yeah, you can definitely do one on your own.
Thanks, Mark, and thank you for joining us for today's webinar on federal tax brought to you by McKonly and Asbury. We will be sticking around for a while to answer some more of your questions that have been coming in, and please continue to submit them or email us directly with any questions, and we will be happy to answer them. As a reminder, you will be receiving CPE credit for attending this 1-hour webinar. CPE certifications will be sent out via email within the next week. You will be receiving a follow-up email to this webinar with a link to a short survey about the webinar that we would appreciate your feedback on. We will be posting a recap of today's presentation on our blog at www.macpas.com/MA-news. Look for that post to be up by the end of the day tomorrow. Now I'm going to turn it back over to Mark and Marta to answer a few more questions that we have coming in.
It looks as though we're having a couple questions come through on the de minimis rule related to acquisitions. And one of the questions that is actually a really good question is, would a reviewed financial statement that is required by the bank meet the definition of an applicable financial statement? And the answer is no. By definition, the financial statement used for credit purposes must be a certified financial statement that is signed off by an independent CPA. So even if you have a reviewed financial statement that goes to the bank, that isn't going to qualify as far as the definition to fall under the de minimis rule. Another question that came through is on the de minimis rule in applying the same assets, like as far as when you're purchasing assets and applying the ceiling amounts, would that apply to each individual asset? Like if you bought a group of assets, would the ceiling amount apply to all the assets or the aggregate, all of the assets, not just a specific purchase? And the answer is it has to be applied to all of your assets, not just a group of assets that are similar, such as windows or something like that. I know we referred to it earlier today. It would apply to all the assets that are purchased by the company.
We do have, looks like one final question here. Someone asks, what's a typical dollar benefit to doing a cost seg study? Typically, we've seen for about every $100,000 of assets that are placed in service and originally put into 39-year property, for every $100,000 moved from 39 to 5-year property, you save about $20,000, and that's net present value savings, and that's using an 8% discount rate and a net 40% effective tax rate. Obviously, out of that, you'd also have to net out any fees to do the study, but generally, I know the firm that we work with to do the cost seg studies. They just do time and materials, and obviously they're in the business to make it worth your while to do the study, so you'd still see a lot of that 20% savings there. All right, looks like that's it for our questions. Thank you, everyone, for attending today. If you do have any questions that you think of later, feel free to contact us. I see our contact information is up on the screen now, so you have that. If you need anything, just let us know. And I will wrap up with just one final thought. We see most of our clients spend a lot of time on depreciation for GAAP purposes, making sure they're getting them right from the financial statements. And while that is obviously very important, it is just as important to make sure we spend some time on the tax side, make sure we're getting those savings there. So don't neglect tax in the long run because you'll save some money. Thank you, everyone.